To an all-time low. It's touched 14.18 to the dollar. I saw that just a few minutes ago. That level it has never been at before. Crucial data released in the United States has confirmed the worst fears of emerging markets like our own. It's added impetus to the belief that the US will raise interest rates in December for the first time in years. The data is positive for America, suggesting the labor market is picking up. But that's bad news for South Africa generally, because it means the US Fed Reserve will likely decide that the US economy is strong enough to withstand that rate hike. A hike expected to woo investors back to the US. It could cause an exodus out of emerging markets like our own. Earlier, my colleague Colin spoke to Michael Keenan, a currency expert from ABSA. Let's take a look.
Well, after 2 months of consecutive weak growth in the employment sector in the US, this afternoon, we had some very encouraging figures out of the US. Basically, non-farm payrolls came out a lot higher than expected. 273,000 odd jobs were created in the US last month, well above market expectations. And this means that the chances of an interest rate hike in the US at the December meeting is now highly likely. Remember that the Fed has continued to tell us that interest rate hikes are going to be very dependent on the data flow that we get out. This is one of the key data prints that we've seen. We've also seen some pretty upbeat commentary from the Fed Governor Yellen in the last 2 weeks. So we believe now, and I think the vast majority of the market believes, that the Fed will start increasing interest rates by 25 basis points on December the 16th.
What do you make out of the throw-in by Donald Trump that Yellen could have perhaps already have hiked by now?
Well, I mean, I think there was a lot of uncertainty brought to the table a couple of months ago. A lot of people were expecting the Fed to hike rates as early as September. So it was a 50-50 call by the market. But I think, when we had that announcement by China that they were devaluing their currency, there was a lot of volatility in the market. The Fed decided to err on the side of caution. The data was also strong at that time. Then we had that slump, as I say, over the last 2 months, and it looked as though the Fed's decision was vindicated. But now it looks once again that the US economy is healing and they are able to withstand a further hike. There's still no big inflation in the US, but the economy does look strong enough to weather another hike, or a hike.
Looking at what the US is targeting right now is inflation, but at the moment in other countries there isn't so much inflation taking place, because it would depend then on the sneeze of the United States for that to have a cascading effect on emerging economies and so forth. So right now, what should happen, the balance of things?
Yeah, it's an interesting question. I think in the US there is no real strong inflation. In South Africa, inflation is starting to pick up once again after being at very low levels. Governor Keenan mentioned that this afternoon as well, that there are increasing risks on the inflation front. There's a lot of challenges facing a lot of these emerging markets, like you say. I think, though, the big deflationary effect has been China and softer commodity prices. That has really brought down a lot of import prices for a lot of countries. In emerging markets, it hasn't been clear cut, because whilst we've got relief from things like oil prices, we've also had to incur a weaker exchange rate. So the two have kind of offset each other. But still, I think in South Africa's case, most of the inflationary pressures that we're seeing coming through aren't because you and I are spending more. There's not a demand push in the economy coming through. It's more a function of exogenous shocks, global factors that are driving our inflation higher. And we think that inflation will probably get up to around 6% in the first quarter of next year. So that's at the top end of the target band.
What is the preferred direction? I mean, like we know in recent months, the whole world had expected the rate to be increased, but then when it got to that stage, there was a postponement. And the likelihood of the Fed increasing the rate now is very, very likely now. At the moment, do you think that this is going to have a very negative or cascading effect on emerging economies? For example, in South Africa, we are having the rand being very, very, very weak against other international currencies.
Absolutely. So I think what we've seen over the past 5 or 6 years, we've seen a lot of money being injected into the markets in the form of quantitative easing. We've seen interest rates go lower across the globe. So all that excess money, if you like, has been funneled into emerging markets, and we've benefited from that together with other emerging markets. Now that it looks like that money is going to be taken back from countries like the US, it means that emerging markets are under pressure. If they start seeing capital withdrawals, then their currencies are going to probably have to weaken. And perhaps it's something that will help on the growth front. Remember, we do have a significant export sector in this economy. A weaker currency, as the governor himself mentioned again this afternoon, can provide a silver lining on that side of things. So, with economies or economics, it's always that balancing act, like you say. And I think at the moment we must just get used to the fact that we're probably going to have a weaker exchange rate for longer, together with other emerging markets. Inflation is going to pick up. But hopefully, with that, we will start seeing better growth, which I think ultimately is what we would really need so desperately in this country.
Colin speaking to Michael Keenan, currency expert. A reminder, our rand hitting an all-time low just an hour or so ago.